Engler's words as much as I did. On a personal note, I had the privilege of working for the governor towards the end of his final term, and I have to say he's one of the, as you heard today, one of the ablest minds on policy and politics that I've ever been around. And I'm glad he stayed involved on the national stage following his public service. As they surely know, the manufacturers have the right man at the table in Washington in John Engler, and so we're very grateful for his presence here today. We're going to turn our attention now to Wall Street. Specifically, we're going to ask our panelists 3 basic questions and let the discussion go from there. First, how the heck did we end up in this mess? We had an event last week at which our keynote speaker put a picture of a rather large man in a tank top eating a sausage to underscore his thesis that firms like Lehman Brothers and Merrill Lynch got sick because, quote, they ate their own sausage, unquote. Meaning that they invested in the convoluted instruments they were peddling and went down along with their investors. We'll see if our panelists have some similarly colorful analysis with or without photos to back it up. Secondly, we'll get at the issue of how we get back to some form of stability in the financial markets. Is the $700 billion rescue plan working? Should we expect it to, and if so, when? What changes are needed on the regulatory front to return some confidence to the markets? And to keep them reinvigorate them in what they do best, which is economic growth and wealth building. How does Washington stay ahead of, or at least reasonably in sync with the creativity of Wall Street in protecting investors while not stifling positive market forces? And then finally, what do the investments that the federal government has already made, which will likely be only a down payment on the overall tab for recovery, mean for budget, fiscal, and economic policy in Washington, including the housing market? And what should a redesigned post-bubble regulatory regime look like? So we'll ask, and I think in the course of their opening comments, probably hear from each of the panelists on those issues. Allow me to introduce them, and then we'll go to their remarks. To my immediate left is Bill Hoagland. He's the Vice President of Public Policy at Cigna Corporation. He was formerly a policy advisor and top budget aide to former Senate Majority Leader Bill Frist. He's an expert on federal budget policy, income security, and food and nutrition policy. He has served as the staff director of the Senate Budget Committee, special assistant to the Agriculture Secretary, and staff economist at the Congressional Budget Office. To his left is my colleague, Ellen Seidman from the New America Foundation. And let me get to Ellen's proper introduction here. Ellen is the Financial Services Policy Director in the Asset Building Program at New America. In this capacity, she provides national leadership on public policy issues related to expanding access to wealth-building financial services, especially for low and moderate-income families. She works on improving financial education, forging a new responsibility framework for consumer financial services in the 21st century, and helping Americans to better manage their debt. A major focus of Ellen's work has been to develop a novel, forward-looking policy framework to encourage greater responsibility and accountability in the delivery of financial services, obviously a pressing topic at the moment, particularly to low, moderate, and middle-income Americans. In addition to her work at New America, Ellen serves as the Executive Vice President for National Policy and Partnership Development at Shore Bank Corporation, which is the nation's first and leading community development and environmental banking corporation. Ellen served as a senior counsel to the Democratic staff of the Financial Services Committee of the U.S. House of Representatives from 1997 to 2001. She was the director of the U.S. Treasury Department's Office of Thrift Supervision, heading the 1,200-person bureau responsible for regulating more than 1,000 savings associations around the United States. She holds a bachelor's degree from Radcliffe College, a law degree from Georgetown, and an MBA in Finance and Investments from George Washington University. Seated next to Ellen is Josh Rosner. Josh is the managing director at the independent research consultancy Graham Fisher & Co., where he advises regulators and institutional investors on housing and mortgage finance issues. Previously, he was the managing director of financial services research for Medley Global Advisors, the premier provider of policy information on monetary, fiscal, regulatory, and political developments to many of the world's leading banks, mutual funds, hedge funds, and other institutional investors, and from whose founder we heard earlier this morning. Mr. Rosner was among the first analysts to identify operational and accounting problems in the government-sponsored enterprises, Fannie and Freddie. Also to identify the peak in the housing market, the likelihood of contagion in the credit markets, and the weaknesses in the credit rating agencies' collateralized debt obligation assessments. His work on GSEs, credit rating agencies, mortgage markets, and other areas have resulted in invitations to present both privately and publicly before numerous organizations in Washington, New York, and elsewhere. He's a graduate of Princeton University and Harvard Law School. Oh, excuse me. Went into Mr. Longstreth's introduction there. Josh, I'm not sure where you went to school, quite honestly, but I'm sure they were excellent institutions. Do you want to plug your alma mater? Okay. Finally, on the far left is Beavis Longstreth. First of all, I want to apologize. In my error, I included a bio in your packet today that is about 3 years out of date, and for a person as busy and active and influential as Beavis, that means it's way out of date. So I apologize for that, and I apologize to Beavis. Let me give you some parts of the biography which remain in date. From 1981 to 1984, Beavis Longstreth served as a 60th Commissioner of the Securities and Exchange Commission. In 1993, he retired from the practice of law as a senior partner at New York law firm Debevoise and Plimpton to teach at Columbia Law School and pursue other interests. Mr. Longstreth is a former member of the Board of Governors of the American Stock Exchange and of the National Adjudicatory Council of NASD, served on the panel on audit effectiveness appointed by the Public Oversight Board, and for many years he served on the Pension Finance Committee of the World Bank. Over his professional career, Mr. Longstreth has written many articles, as well as 2 books on finance, corporate behavior, and the law. And he is a graduate of Princeton University and Harvard Law School. He also published his first work of fiction in 2005, interestingly enough, called Spindle and Bow. So as you can see, we have a distinguished group of panelists, and I am going to hand off, starting with Bill Hoagland, and you can stay right where you're seated, to kick things off, and then we'll have a little Q&A and a moderated discussion. Thank you.
Thank you, Frank. Thank you, Frank. I'm going to leave it to my colleagues up here to deal with a number of the Wall Street issues. I obviously, with my background, are going to try to focus a little briefly on your post-bubble situation. And it's hard, it seems to me, to discuss longer-term fiscal policy without figuring out how we are going to get from where we are today to that post-bubble situation. And on that score, I think I was unable to be here with you this morning, but I assume you've discussed it at some length. It should be clear that the focus of the new administration and the Congress coming in is to stimulate near-term, and how they do that will, unless they do it very carefully, it seems to me, there's a real possibility of only increasing the long-term fiscal challenges further than we already have. To be honest with you, at least today, I'm not as concerned about where the dollars will go as much as I am concerned about where they will come from. With all due respect to Maya and Bill Frenzel and the Committee for a Responsible Federal Budget, which I'm a proud member of, I don't think the size of the federal budget deficit is really going to matter much at all during this first year of the new President Congress, and maybe it shouldn't. There's a chart that I put together, which is, a lot of people do these kinds of things. I think Maya has a chart similar, made available to you. It reiterates what a lot of people have already said. Basically, the various estimates can be made on, and all will be off somewhat, but I think almost all of analysts who look at this agree that we're looking at a shock and awe deficit for this current fiscal year of close to $1 trillion. Maybe slightly less, depending upon getting into some of the geeky stuff, how we keep the bank equity purchases, either under credit scorekeeping or under direct outlays. But regardless, we all know that we're facing a large amount of money injected into the financial system from the Treasury, and it's going to add to our borrowing requirements. The guesstimate that's on that particular chart also shows that I assume that we'll have a stimulus package in the neighborhood of 150 to $300 billion. And I also have tried to put on that particular chart the estimates for the Senator Obama's campaign promises on health care reform. I'm sure you've heard the figure, $1 trillion is about 7% of GDP. I got a different way of looking at this. Besides the fact that 7% is the largest number since 1946, I've got a different way of looking at it. And that is that if you think about it for a second, the cumulative federal debt in this country from the beginning of the Republic, we had to go till 1981. Most of us can remember 1981. We had to go from the beginning of the Republic till 1981 to accumulate $1 trillion. In 1 year, this fiscal year, we will add $1 trillion to the federal debt. Now, as I said, I think the question that I face is a little bit more, where are the dollars going to come from? Since January of 2001, 82% of the government's private debt holdings have been purchased by foreign investors. And I think there are two current events that may suggest that this will not continue. The first is the most obvious one in this weekend's, obviously this morning's newspaper also, and that's the Chinese decision over the weekend to have its massive infrastructure spending package. Cynically, I would say, could say that that's reducing the available Chinese foreign investments into our infrastructure by them making that decision. And second, a little bit more difficult, is this upcoming International Economic Summit here this Saturday. I think the focus of that on restructuring or creating a new international financial system is in the cards, and maybe not so subtly replace the dollar-based pattern of exchanges inherited since Bretton Woods. I think there's been a growing resentment, particularly in the EU, I would argue, over the ability of the U.S. to run fiscal deficits on the strength of the dollar's reserve currency status in the world, especially as the euro has become much stronger. For now, however, it seems the only way that we're going to get through the current situation into a bubble, into a post-bubble situation, is to substitute sovereign debt for private consumer and corporate debt. And sadly, by the way, this is not just a federal issue. Voters last week approved almost every state-level bond measure on display. And it's not surprising, voters' antipathy toward raising taxes, but state and local policymakers are going to have to protect their state's credit ratings by cutting spending near term and longer term to pay the interest on the borrowed money. It's probably the worst possible situation you could have right now is for states to be cutting back, but that's what they're going to have to do. But interesting enough, is it not, that what happens is then we shift it back here to a fiscal stimulus package that provides state and federal aid, so it's shifting that borrowing to federal borrowing. Now, some analysts believe that's savvy on the part of the state voters, taking a long-term view that things will be a lot better 20 years from now than they are. I hope so. But for the federal government, we know that the next 20 years of the federal budget balance sheets are going to get a lot more difficult. Two facts. If President-elect Obama has a second term in office, toward the end of the second term, that the Social Security cash balances will be out, flat going. The cash balance, you don't have to wait till 2041 on the asset. It's the cash balance. The cash, we'll be spending more than we're taking in, and the cash balances are gone. And of course, then the HI trust fund, the health care, that's already spending more than we're taking in the HI bill, HI taxes. And if you believe in trust funds, assets of that trust fund will completely be defaulted at the end of his second term. What I fear is that the only way to fund these short-term spending demands that are going to come at us, or are coming at us, without making the hard sacrifices of reducing entitlement spending, and let's be honest what we're talking about, Medicare and Medicaid at the federal level. Or dare I say, if we don't want to do that, if we're not willing to raise taxes, one that hardly was discussed except for those with incomes over $250,000 in the latest campaign, the short of those enacted policies, then foreign investors will either have to continue to fund our public deficit, or the Fed will have no choice but to crank up its printing machines. And it seems to me those who all of a sudden have become in vogue neo-Keynesians would do well to remind the public of another Keynesian theory, and that is, in the long run, we overturn the existing basis of society by debauching our currency. So the central and most fundamental fiscal challenge to the new administration, the 111th Congress, as I see it, will be how to formulate these demand-increasing policies for the current crisis without exacerbating what was already an unsustainable fiscal path prior to the crisis. The good news, if there is any, is that I think the vast majority of those in Congress, as well as the incoming president, fully understand that we were on an unsustainable fiscal path prior to this crisis, let alone now after the crisis. That most recent, as everybody's seen, it's the top line on that chart there, would be the baseline projections from CBO back in September. Even in a pre-crisis situation, foresaw deficits throughout the projection horizon, with the benefit, by the way, of letting those tax cuts expire in 2010. So the conflict between these new neo-Keynesians, I call them, and for lack of a better description, the blue dogs, I think is going to be revealed very clearly, very shortly. Let me give you the example of how this might reveal itself. Getting a little budget geeky here with you for a second. The congressional construction of that congressional baseline is specified for all practical purposes in the budget law, in the Balanced Budget Act of 1985. It is also locked in for purposes of scoring and pay-go rules for the current Congress based upon its 2008 budget resolution. So, as you will see, the expiring tax cuts in 2010 that are built into that baseline, those in the 10% tax bracket, the child tax credits, the estate, all those, if they expire, then revenues are going to come back up between $150 to $200 billion. And this is why the deficit line appears to improve at least a little bit in some charts. Now, the president-elect has said he would cut taxes for everyone except for those with incomes over $250,000. The truth is he would extend the tax cuts that already exist, and therefore, being technically correct, he would since many of the new Democratic members replaced Republicans from conservative districts. So the first real test of fiscal discipline going forward may come just next week when the new rules of the 111th Congress get discussed during the lame duck session. At the end of the day, Speaker Pelosi must find some accommodation for these two factions within her Democratic caucus, or, and I don't think this would necessarily be a bad thing, Speaker Pelosi might have to reach out to House Republicans to find a bipartisan majority on the future of pay-go. One possibility always exists, very simple. The original Budget Enforcement Act in 1990 that included a de-triggering of pay-go in time of war or recession. I don't think there's much question in my mind when the fourth quarter GDP advance figure comes out. It will be about 8 days after the president takes his oath of office, and end of January, January the 28th, and based upon what you just heard and others, that should be close to a negative 3 to 4% real. There's just no question that's going to have a real impact on the thinking going forward. But let's be honest. All the expiring tax provisions are going to be extended. Obama's campaign pledges make that clear. And there will be another stimulus package, whether in the upcoming lame duck next week or early in the Congress, with or without the speed bump of pay-goes. It is presumptuous on my part to even think that I know what the recipes are for a recovery if we ever get to post-bubble. But long-term, I do not think it's possible to discuss entitlement reform, health care reform, without discussing tax reform. To me, the two are inextricably linked. So if there is to be a big bang legislative approach in the new Congress to fiscal policy, then it would be, I think, an opportune time to create some linkages or maybe even another triggering mechanism between what Congress does to provide that demand increasing bang linked to some silencing entitlement and reform proposals in this session.
Thanks, Bill. Alan?
Thanks very much. I'm going to focus on the regulatory issues, and I want to start by laying out some thoughts about how we should think about regulation that are based on a paper that's in your packets. We published this last month. It's by Michael Barr, Sendel Mullnathan, and Eldar Shafir, a lawyer and two behavioral economists, and they call it Behaviorally Informed Financial Services Regulation. The theory of this paper is that real human beings are very different from the rational economic beings on which much regulation is based. As the authors put it, behavioral research has shown that the availability of data does not always lead to communication and knowledge. Understanding and intention do not necessarily lead to action. And contextual nuances can lead to poor choices. Individuals consistently make choices that they themselves agree diminish their own well-being in significant ways. The paper's focused on regulation in the consumer financial services market, but I think its principles are applicable to what we're discussing here. The authors urge us to think about the incentives that affect the behavior of both the regulated and the intended beneficiaries of those regulations, and to take those incentives into account when regulating. And I think we ought to think about the incentives that relate to the regulators also. Thus, just to take an example from the summer of 2007, if countries, the regulators, are competing for status as a financial marketplace, and firms, the regulated, believe that full risk disclosure is not in their best interest, and investors, the intended beneficiaries, believe that yield can be obtained with very little risk, should anyone be surprised if transparency suffers? And in thinking about incentives, we need to focus on and learn explicitly to use two types of levers, what Barr and his colleagues call changing the rules and changing the scoring. Changing the rules is all about what a regulatory system says you can and cannot do. You must hold capital. You must submit quarterly financial reports. You must disclose certain information about loans. You cannot discriminate on the basis of race or gender. Changing the scoring is about the consequences of failing to obey the rules. If you don't have enough capital, you need to raise more, or you might get shut down. If you don't do ARM calculations right, you fix them retroactively. If you discriminate, maybe you can't merge. And if your disclosures are unintelligible, maybe you shouldn't be able to collect on that loan. So how might these principles apply in the current context? I'm going to use the framework of banking regulation because that's what I know best, recognizing full well that systemic risk regulation is a major gap that needs to be filled. We need to be thinking and regulating both functionally rather than according to corporate form, and in the context of entire holding companies and entire holding company families rather than looking at one entity at a time, and internationally as well as domestically. And while I think the banking framework is valuable, it has plenty of room for improvement, and the most notable is in the fact that suitability regulation is part of the securities law system but not part of the banking law system. I'd like to focus on 5 key regulatory concepts, building on what we've learned from the current unpleasantness. Consistency of regulation, effective enforcement, transparency, although in a slightly different way than we've been discussing, capital adequacy, and having a stake. The behavioral economists asked us to focus on context. And 2 important elements of context for firms are competition and shareholder expectations. While many of us would like to believe that goodness in the form of corporate social responsibility, environmental improvements that don't have an immediate payoff, and full transparency can be competitive advantages, I think that what we're going through now strongly suggests that given the opportunity, the context of competitive and shareholder pressures generates a strong incentive to fall to the lowest common denominator of behavior that has no immediate negative consequences. Or more succinctly, business practice will flow downhill to the practices of the least regulated. I think that's particularly true when the short-term risk-reward calculation may be different in amount, direction, and distribution from the long term. Thus, consistency of regulation across all types of entities that are engaged in functionally the same type of transaction, no matter what the corporate form of the entity doing the transaction, is an important rule of the game. Now, at the same time, we need to pay some attention to the size of the entity being regulated. For example, our current banking regulatory system has, I believe, the perverse effect that small institutions are regulated more closely because it's easier to do that. And in particular, it's easier to do that with limited resources. Sure, we put more resources into larger institutions, but we don't put commensurately more resources in line with the risk. The second important contextual element relates to getting the scoring right, and that's effective enforcement. This includes both the will to regulate, something that many see as having been lacking recently, and effective enforcement of regulations that do exist, something I worry about a lot as we think about, for example, tougher rules for mortgage brokers or payday lenders, or applying something like the Community Reinvestment Act to non-bank entities. But truly effective enforcement also means being cognizant of the practical limits of supervision and thinking about how to create incentives and contexts that supplement formal enforcement strategies. That's where the concept of transparency comes in. I think transparency is critical to making sure the game gets scored right. So we need to make public a far greater amount of information about how institutions are behaving when that behavior affects the public, and make sure the information is timely and in a format that can be fairly easily used by those who are interested. In the banking world, this is exemplified by call reports, the quarterly financial reports, and the Home Mortgage Disclosure Act, and to a lesser extent by the fact that the Community Reinvestment Act evaluations, unlike all other bank examinations, are public. HMDA needs to be expanded to small business lending, where there's ineffective disclosure, to other essential consumer financial services, where there's none, and I would argue to corporate investments in community and the environment, which is required to some extent in the EU, but not here. The importance of this kind of transparency is that it enables limited regulatory resources to be leveraged by the public and their representatives, including state attorneys general, the media, community-based organizations, and competitors. When information is transparent, when competitors know what is going on, competition operates in a way that will benefit. When everybody is hiding, competition operates mainly in a way that involves guessing, non-transparency, and getting around rules. As I mentioned earlier, capital adequacy is a key rule of the game. We need far greater ability and will to assess and understand risk across entities and across countries. And we need to change the dialogue so that maximum financial leverage is not regarded as the sign of a strong corporation, but a weak one. At the same time, I think we need to make sure we're counting in a manner that is counter-cyclical, not pro-cyclical. It is absolutely absurd that the banking regulators were fighting with the securities regulators and the accounting profession back at the beginning of this mess for greater loan loss reserves, but being told that they weren't justified because the loans hadn't failed yet. But, you know, if we're going to insist on the purity of loan loss reserves, then let's do something more directly about capital, like indexing capital requirements to a relevant asset index, so they go up in good times, provide a cushion as things get bad, and don't stifle lending when we most need it. Finally, and in the most clear example of getting inside the head of the players in the system, we need to ensure that everyone involved, companies, boards, employees, agents, and customers, has a financial stake in the long-term performance of both the financial institutions and financial transactions. So this is critical in part because we know that the public, as we've seen in the devastation the current debacle is wreaking on communities, has a very big financial stake. Two major manifestations of having a stake are skin in the game in any set of transactions where some risk is transferred, and compensation systems that take into account long-term performance, both at the corporate level and with respect to any transaction that has a long tail. Designing, enacting, and implementing a regulatory strategy that will not only get us beyond the current mess, but also sustain a healthy economy and financial system into the future will be extremely difficult. But if we remember that we're dealing with humans and regulate in a manner that recognizes and takes into account their foibles and their incentives, we have a better chance of being successful. Thank you.
Thanks, Ellen.
Josh?
I actually would like to sort of step back and talk about what I think the roots of it are, because we constantly hear the roots of the problem are housing. And I think the root of the problem really is that false belief in what we've misinterpreted as the implementation of efficient market theory. We seem to have all forgotten that markets are only efficient when both parties to a transaction have equal access to information. And what we built up over the past decade actually was a system almost intentionally by which both sides of a transaction did not have equal access to information. And definitionally, we therefore set up and put in place the seeds of our own demise. And to go back just a little bit, because I don't think housing is the problem. The problem, I think, is actually several other problems. It's a problem of mismanagement of correlation assumptions by rating agencies, by risk managers, by investors, who seem to have all forgotten that their models often miss that when times are bad, correlation moves to 1, which is to say that each of the CDS transactions, as example, could be managed in normal times because 2 players would net to 0 on a transaction. The problem is when everyone actually has to transact at exactly the same time, there's not enough capital in the system. And it's this type of mismodeling and mismanagement of correlation that actually really has amplified the problems that are before us. Over-reliance on the ratings agencies and models which were often applied to previously non-existent collateral. The subprime borrower didn't exist prior to this cycle. And in fact, in 95, 96, 97, there was a subprime market. I had actually placed probably embarrassingly 50% of the equities of every single one of the subprime companies then. But they were offering standard mortgage products to a borrower who was a lower credit score borrower. And that industry disappeared overnight. It was small enough that no one really noticed, and companies like Cityscape Financial and Migo Mortgage and Conti Financial just disappeared because they lost access to the securitization markets when people realized that their gain on sale assumptions were wrong. So this isn't novel. I think what we really have to step back and realize is that we've redefined the rules so badly this time. Home ownership, as example. In 2001, I had, summer of 2001, I had clients coming to me and saying, look, we just came out of a short-lived recession. Housing typically lags by 12 to 18 months, or we're going to see a housing downturn. And I wrote a rather lengthy research paper that I presented at the American Urban Real Estate Economists Association, in which I said housing is going to outperform GDP for the next several years. And that's going to be driven not by healthy fundamentals, but by unhealthy fundamentals, because down payment requirements, which have persisted since the 1700s in this country, have been brought from 20% to 0. We've moved from appraisers being independent, community-chosen players to either automated or chosen by the realtor. We've changed the underwriting from traditional in-market underwriting to national automated underwriting by consolidated and concentrated originators. And on the back end, we've hidden all of the losses that we're seeing through the innovative use of loss mitigation techniques, which, by the way, still seems to be one of Washington's favorite ways of hiding reality, given the fact that even at FHA and at Fannie and Freddie, loan modifications typically result in somewhere between a 20 and 25% redefault rate in 2 years, which seems to me a subject that should be one of social policy discussions at this point when we're reconsidering regulation for the industry. That said, I couldn't agree more that capital is going to be the question, and where it comes from is going to be sort of the big concern. And capital typically flows to rules-based markets that are transparent, that are deep and broad, where all of the players understand the rules. And unfortunately, the missteps that we've had, each step of this crisis, have taken us further and further and further from clear markets with clear rules. And I think that poses actually the greatest threat at this point to foreign investors' willingness to participate. beyond that, since I started by saying housing is a symptom, it's not the root, and correlation and mismodeling, I think when we go back and we look at at this period, we'll probably call it when models failed. We're at the front end of this crisis. Actually, about 6 or 7 months ago, I was being interviewed, and I said, look, I don't agree with Dick Folds, and I don't agree with John Mack. We're not in the 7th inning. We're in the 2nd or 3rd inning. And I called that reporter actually last week and said, you know, I hate to say it, but 2nd inning. Yeah. And I really quite sincerely believe that. In February of 2007, I wrote a paper which I presented at the Hudson Institute on mismodeling in the collateralized debt obligation market and the risk that CDOs posed not only to investors and RMBS markets and originations, but therefore to the broader economy. It was looking at it sort of in reverse of the way people typically do and expecting that we would see contagion. Well, we're finally at the front end of the impact to the real economy, and I really do mean the front end. I would expect that sometime in the first quarter of next year, we're going to see credit card defaults start scaling to record levels. And by 3rd quarter, I would expect that we are going to start to recognize what will be understood to be the highest level of corporate defaults, certainly in U.S. and probably in world history. And that actually also leads me to believe that the likely unemployment figures that we heard earlier are going to be conservative, especially when you start looking through MSA level data and realizing that there are some of the fastest appreciating MSAs where more than 1 in 5 jobs created over the past 7 years were tied to housing. Okay? And people kept saying earlier this year, look, unemployment figures are good. Well, in a consumer-led slowdown, it works the opposite. Okay? Unemployment is a lagging indicator, and that's where we stand, unfortunately. So the borrower stops going to the store, the retail store shuts down. We saw Circuit City file this morning. If anyone didn't notice or know that, Circuit City filed for bankruptcy this morning. And that moves then to the manufacturing, to the warehouse, and ultimately to the office market. And I think we're still at the very front end of that. Now, I think, now that I've cheered everyone in the room up, we should talk about sort of where we are and what we should be thinking about. I don't believe that the $700 billion, while it's a nice number, is being effectively or efficiently used. I think that there is no regulation on markets, and part of the problem here, and frankly, ironically, I think that some of the biggest problems exist in the 9 institutions that were given the money first, okay? Why did this whole problem happen? How did we end up here? Well, we've got about 8,500 banks in the United States. And thankfully, as much as we start hearing calls for a unified single regulator, I think it's important to stop and recognize that if we had a single regulator, that is to say, if we were all actually fashioned in the image of God, we'd all fall down at exactly the same time. And I don't think that's what we want to have happen. So I actually think that the dual banking system actually served some wonderful purpose and actually saved us here. Part of the problem is the big institutions, largely because of the leverage ratio, it became harder and harder for them to generate returns for their shareholders. Therefore, they actually began to rely on products, on securities that could get rated, or ranked, I should say, as residential mortgage securities, the lowest risk weighting, though they were internally leveraged. And that regulatory arbitrage, passing it by the regulator so that they actually considered RMBS as residential mortgage assets, as opposed to considering them leveraged instruments, was part of the problem here. Now, thankfully, most of our community banks, our state-chartered banks, actually avoided all of this. They are suffering at this point, but what they're suffering from is the typical cyclical deterioration of their loan book. Okay? So, as I say to clients, they've got degenerative disease. And in some of the cases, those degenerative disease will kill them because this is going to be a severe cycle. And they need to be forced to raise capital at this point. And it will be dilutive as hell to shareholders. But that's what needs to happen. The same thing at the big banks. Unfortunately, they're not suffering degenerative disease, but because of their reliance on so many of these internally leveraged securities, they actually have severe coronary disease. Okay? and we keep seeing them drop from heart attacks. And so if we're going to give them money, it seems that we need to do two things first. If you're giving an institution $25 billion and hoping that it will do something with that $25 billion, you should be sure that they actually clean out the rat's nest of securities that continue to deteriorate. Otherwise, that $25 billion is just going to be held on their balance sheet for regulatory capital purposes. And that's primarily what we're seeing happen at this point. So it's not that the idea of $700 billion isn't a good idea, it's the implementation of it, okay? And in fact, given the fact that the regulatory community has a very hard time, just as the Wall Street community does, analyzing the large, complex institutions, there should be a market mechanism requiring institutions to raise capital in the public markets before Treasury or the government is comfortable putting capital in. That would actually allow us to know who the markets believe is a survivor and who isn't a survivor. And I think that's an important feature as well. Going forward, I think one of my big fears is that securitization is going to be blamed for so much of the crisis. And securitization is a worthy and necessary tool. By the way, I should actually give a little disclaimer. Our firm doesn't do any business with any trade associations. We don't lobby. We don't take any money from anyone other than our clients or institutional investors, most of whom, well, the way we always say it is about half of whom hate us on any given day. And so my pitch for securitization is it was deeply flawed in its implementation. It is of vital importance to the functioning of our capital markets. And that would have been my first area to approach, which is if we had an industry standard pooling and servicing agreement, an industry standard for reps and warranties, if we had very simple securitization structures without the waterfall and the deep tranching, okay? If we had standards of collateral definitions, if I said to you today, is subprime defined by the borrower or the product, no one in this room could answer. Unfortunately, just as no one could answer in this room today, is default, is there a standard definition of default? Well, it used to be functionally 90 days was a default. Today, actually, there's no standard definition of default. And that goes back to what we talked about at the beginning, which is standards and rules and understandings, right? Communication, language is a compromise, and we need to compromise on terms and come to standard understandings of those terms. And I think one of the things, and we'll leave this and open it back up after to further discussion, I think that actually moral hazard, to me, the most damaging and the sort of most disturbing statement that's been made during this crisis was by our Treasury Secretary, who said that we have to recognize perhaps that there are institutions that are too big to fail. And I fear that that is a genie that will be very hard to get back in the box. And I think that we have gone into this whole crisis mode without thinking about how are we going to unplug all of these appendages that we're plugging into the government, and we don't have a strategy. Now, I will say that there's a piece of rulemaking that thankfully is in process that seems to have slipped under the radar, which I do find very hopeful on the moral hazard side. First of all, the risks, or two of the risks of bank runs that have historically existed are deposit runs and counterparty issues. The deposit run has largely been taken care of by the increase to $250,000 on insurance and the insurance on non-interest-bearing accounts, transaction accounts, coupled with the debt guarantees. And I think so we've taken care of the risk of bank runs. So the big risk that's still in front of us that would argue that there is a world of institutions that are too big to fail is counterparty risk. But the FDIC actually had a notice of proposed rulemaking that is FIL 75-08, which is on qualified financial contracts. And that rule essentially serves two purposes. One, historically a troubled institution from an FDIC perspective was one that was rated a 4 or a 5 on the unified exam. Now that becomes problematic as we talked about these large complex institutions. If we Wall Street analysts can't analyze them, how can we expect an examiner to really feel comfortable saying this large institution that's unanalyzable is troubled? right? There are a few examiners who are going to be willing to stand up there when the head of their Fed bank calls them in and says, well, I just got a call from the bank, the examined institution, complaining that you gave them a 4 or 5. How do you justify it? Well, I can't justify it because I can't analyze them. So this FDIC rule actually says that a 3 for an institution over $10 billion in assets is a troubled institution. And I think that actually, for the time being, is a very valuable tool because it allows the backup regulator, the FDIC, some greater measure of surveillance and exam. The second piece is that for troubled institutions, the FDIC has the authority in this rule to approach an institution and say, by close of business today, we want you to provide us all documentation on all of your counterparties. We want to know all of the counterparties, all of the people in your organization who are involved with the counterparties. We want org charts. We want org charts for the counterparty. By getting that information, it actually starts paving the way for putting that genie back in the bottle. And I actually would applaud, because I think that's actually probably the most important act that we've seen in this crisis management. And it has largely gone unnoticed. So with that, actually, we can come back to anything else in Q&A.
Great. Beavis?
Yeah. I want to, I can't resist the discretion of Mr. Rosner. If God were our single regulator, wouldn't there be a chance, just a bare chance, that we might be all lifted up instead of all falling down? But don't answer that because it'll take my time away from what I want to say. I promise you no predictions. So pencils up, you can just sit back and listen. So the global financial condition is a mess, and the mess began in the U.S., and its causes can be traced both to the private sector and to the public sector. Some believe that it was greed on Wall Street and in corporate boardrooms that led to this problem. But for me, since profit-seeking, which some might call greed, is both fundamental goal and driving force of our system, our capitalistic system, I assign major blame for our present condition, our financial condition. I'm not talking about the economy, which is a much bigger issue, and the financial condition has spilled over into a global economy, and those are macro issues I'm not going to try to guess at. But I'm talking about the financial condition. I think that the situation was caused primarily by a failure on the part of regulators to restrain the profit-seeking efforts, which we applaud, and which have a tendency to excess unless modulated. Specifically, I claim that these problems came from too many years of regulatory failure by the principal agencies. I start with the Fed, the other banking regulators, the FDIC, the SEC, the Treasury, and the state insurance regulators. Much has been written about the failures, and if I tried to prove my claim, it would take the rest of my time. I'd like to say something about reform, so I ask you to accept this claim and look with me at underlying causes that might explain the regulatory failures. I'm going to offer 5, each linked to the other. First, the powerful influence of firms subject to regulation over their regulators. Agency capture, it's called. An enduring example would be the state regulators of insurance. Second, the powerful influence of senators and congressmen over these regulators in response to pressures brought to bear on the politicians by the same firms. Here, the poster kids would be Fannie and Freddie. Third, an executive branch that hands over the reins of these agencies to those like Alan Greenspan who harbor a profound distaste for regulation. This is a self-inflicted wound that was enabled by our legislature. Former Fed Chairman Greenspan has long been a disciple of Ayn Rand, whose utopia was greed unrestrained. When appointed, Greenspan's anti-regulatory bent was very well known if anybody looked at the literature. Not only did he espouse this belief and act upon it as chairman, but by dint of his agency's supremacy among financial regulators, he wielded large influences over the rest of the field. How could such appointments be made? Aren't they of a piece with, say, appointing Boone Pickens to head American Electric Power? President Reagan was the table setter for this behavior. He liked to remind his appointees, and I was one of them, and I heard him say it at the White House, that these appointees were picked to carry out the mission of draining the swamp, read federal government, and starving the alligators, read government bureaucrats. Fourth, the doctrinal belief in competing regulatory agencies vying for turf and therefore susceptible to the influences just described. In banking, therefore, just within the federal government, in the Fed, the Comptroller, the currency, FDIC, and OTS. In financial services, SEC and CFTC. In insurance, all the state regulators. The case for offering the regulated a choice of regulator was powerfully made by Alan Greenspan in 1993 and successfully made to defeat the Regal-D'Amato bill to consolidate the 4 banking agencies into one, and in the process take bank regulatory functions away from the Fed, just as Gordon Brown had done to the Bank of England. The Greenspan argument was that having multiple competing regulatory agencies was a valuable technique for holding back excessive regulation. Really. Yes, really, and it worked. This philosophy found its way into Secretary Paulson's March 2008 blueprint for reform, which calls for insurance companies to be offered the choice of a federal or state regulator. Fifth, the doctrinal belief in the effectiveness of self-regulatory organizations, or SROs for short, such as the New York Stock Exchange and the regulatory arm of the NASD. Indeed, in 2004, the SEC carried its confidence in SROs a step beyond, accomplishing one of the most destructive regulatory reforms in living memory. At the behest of the big firms, you remember they used to be called bulge bracket firms, a term that may not be used much anymore. The SEC eliminated its mandatory net capital rule in favor of what is called, or what it called, voluntary oversight. Surely one of the better oxymorons coined in that year. These firms tripled their leverage in an unrestrained, reckless quest for profit, and ultimately, as we now know, drove off a cliff with customers and other dependents in tow. I'm talking about Goldman, Morgan Stanley, Merrill Lynch, Lehman, and Bear Stearns. They're all gone in terms of investment banks. History demonstrates that on really big issues of investor interest and protection, SROs don't work. They do little things, and I'm not diminishing the importance of the little things, although I don't know if it's efficient or not. But for over 60 years, in matters of money, the securities SROs have consistently chosen member self-interest over investor interest. So, those are the 5. How can we address these problems? And here, with reference only to the SEC, I have 6 ideas. Am I running out of time? Short 6 ideas. First, make the SEC self-funding through a portion of the fees it collects, which far exceed its budget, but must, under current law, be turned over to the fisc. The SEC, power over the purse strings doth make cowards of us all, someone said. Independence is impaired. In contrast, the Fed is self-funding, rendering it vastly more independent and therefore resistant to capture or influence. Here's an example of the difference that I happen to know personally. In the late 70s, Congress was about to pass a law called Government in the Sunshine. It required multi-headed agencies like the Fed and the SEC to meet only in public view whenever a majority of its members were involved. Paul Volcker, then chairman of the Fed, told Congress that the governors could not operate this way. He demanded and got an exemption on the common sense argument of effectiveness, agency effectiveness. This argument, of course, applied equally to every other multi-headed agency, but none of them were able to get the same exemption. They lacked independence because they had to come to Congress for their budgets. 2, restore the effectiveness of gatekeepers for public corporations, a class of professionals consisting of lawyers, auditors, rating agencies, and financial intermediaries, by restoring vicarious liability for aiding and abetting securities fraud. Here, legislation would be needed to reverse the effects of the Supreme Court's 1994 decision in the Denver Bank case. The marked decline in professional standards among these gatekeepers began in the mid-90s and can be traced to this case, although there were many other contributing factors along the way. I strongly believe in the potential effectiveness of gatekeepers in strengthening the hand of the regulator. Third, consider having audits of public corporations performed by federal government auditors along the lines of bank examiners. Auditing is a public utility function. That is to say, it's deeply affected with the public interest. The number of large private audit firms capable of handling mid to large size corporations has declined to the point where the 4 firms remaining are simply too few to fail. In addition, following the failure of Arthur Andersen, pressure has continued to grow for capping liability for audit failures. The firms, however, are adamant in opposing a utility-like limit on their profit margins. A case can be made that the profit margin is fundamentally at odds with the audit function, at least where an oligopoly exists, liability is capped, and profits are unconstrained and unknown. I think this case is very strong. I think this idea should be carefully explored. Fourth, consider the creation of a new entity or empower an existing one to uphold the interests of investors in all proceedings before the SEC. It is a remarkable fact that in important rulemaking initiatives of the SEC, the robust representation of investor interest, which is obviously what the SEC is there to protect and represent, is often missing. The SEC is subjected to immense pressure from firms whose conduct will be affected by its initiatives. Without the counterweight of strong investor interest, the SEC can easily succumb to capture, and I think history shows recently that it has, over and over again. The SEC experience stands in sharp contrast to, say, rulemaking initiatives before the EPA. There are a large number of environmental NGOs organized to protect the environment. Theirs is a powerful presence at rulemaking initiatives of the EPA. The Chartered Financial Analysts Institute would, if it were willing, be a good candidate to take on this assignment, or a new entity could be formed, or a different one found. In either case, or in any case, it could be supported from a portion of the fees that are now being collected by the SEC. The fifth idea is to merge the CFTC and SEC, and that, of course, is an old idea. But I think its time has come. Of course, it'll trigger turf battles between the ag committees and the banking committees on Capitol Hill, but we have a momentum of this moment in the country's history that I think could carry this day and avert continuing turf battles between these agencies. The failure to regulate credit default swaps an opaque multi-trillion-dollar market that has already brought down AIG and will, I'm sorry, this is a prediction, bring down others. My only prediction might have been averted had these two agencies been combined when this market started to grow from nothing a decade ago. Sixth, and finally, since an agency is only as good as its leaders, appoint only highly competent people qualified not just by their education and experience, but by a conviction that carrying forward the statutory mission of the agency importantly serves the public interest. In other words, a belief in where they are and doing what they've been assigned to do. Fortunately, with our new president, and this is the final prediction, this point may be unnecessary. Thank you.
We have run a little long, but I think we've gotten a wealth of information here. And for those of you who are willing to stick it out, we have time for Q&A. So, ma'am?
I don't have any time.
If you don't mind. Here you go.
This question is mostly aimed at Josh Rosner. You stress the importance of industry standards, and I'm wondering whether these could be obtained by putting more transactions onto formal exchanges, and if so, is that feasible?
Yeah, I mean, actually, I think the answer is yes. And actually, one of my big areas of concern has been rating agencies. And even there, you know, we forget what a rating is. We forget that what you're trying to do is separate price from value or integrate price and value. And capital markets really serve that purpose, and open exchange of trades, crossing of trades serves that purpose. And that seems to be, yes, I think that is exactly right, to the point where, to me, even in terms of the TARP and the Treasury approach, I would have hoped that instead of hearing some concept of a reverse auction where the interested sellers, a limited number of them actually tell Treasury what the price they're willing to accept for a security is, that we were to have a forward auction where the institutions actually bring their troubled asset list to their primary regulator, who in turn brings the list without identifiers to the Treasury, who arranges a forward auction process by which 10,000 qualified institutional buyers can bid on these securities, which would be the beginnings of creating a market-making effort, a market, and allow price discovery to occur in the market. And I would have actually put that as a precondition also to Treasury capital infusions. But yes, I think that's ultimately the issue. I don't think that charter-constrained investors, those investors, pension, insurance, or banks, should be allowed to purchase structured securities unless they're exchange traded, with very limited carve-out.
Great. Let's keep the questions quick, as this first one was, and we'll get some quick answers. Yes, sir.
Yeah, I'm Jim Vitarello with GAO, and I've read a lot of your excellent articles, Mr. Rosner. I know that you and others have spoken a lot about the misalignments, incentives in the securitization process, from the mortgage broker all the way up to the credit rating agencies. Now, that's easy to say, and I think most of us in this room would agree. The question is, how can you devise a regulatory system that tries to realign the incentives so that people are not just worried about short-term commissions, but long-term performance? Mm-hmm. Is it possible to create a regulatory system, not just in the banking system, but on Wall Street itself, and even with mortgage brokers down at the, at Main Street level, to actually do that? Because without that, I don't see how securitization could ever make a comeback.
Well, first of all, I think securitization can make a comeback without actually having the ratings agencies involved in it at all. Okay? And I think that actually has to be almost a precondition to any move we make going forward. They were never meant to be other than another form of information and an analytical tool. The problem is, where I'm a big critic of them in the structured world, by the way, I'm not really in the corporate debt world. And the reason is that they've had models that have been largely unchanged for almost 100 years on the corporate debt side. Here, they've actually modeled on a learning by doing basis. And there's a number, and actually, I hate to pitch a different organization, but if you go, there was this summer, I made a presentation at AEI at about the time that the SEC put out their their proposed rules, with 7 points that I think actually really do address that. The first 2 of them are, when the rating agency changes their models, they should be required to go back and re-rate all existing outstanding securities rated with the prior model. Well, they aren't required to do that, okay? So if they were, it would become more clear the ratings migration and the failure of their models. Second is that it seems to me that when they rate in the secondary market, they should be required to actually rate using the original assumptions that they used at origination, which they also don't do. So you've got ratings migrations. I do think that there's ways to actually address it. The other points are, you know, firewall issues. I don't buy this notion of issuer pays. I think it's actually a spurious argument. I spent 11 years on traditional sell side of Wall Street, and I will tell you that as an analyst, the number of times that I had institutional investor clients pressuring me to try and change my viewpoint exceeded the number of times that corporate issuers tried to change my view. I think in either case you've got a conflict of interest that needs to be managed, and that's the job of regulators.
Alan, you've
Yeah,
touched quite a bit on this.
Yeah, I think that it can be done. I think that we need to pay attention to the compensation systems. I mean, if you think about the insurance industry, which I usually don't think of as a wonderful, pure, really well-organized industry, the fact of the matter is that a salesman on life insurance gets paid a portion of the premium today, but the rest gets held back. There's no particular reason why those involved in selling mortgages need to be paid all up front, particularly when what we're going to hold back is something based on performance, not on the ability to continue selling the same life insurance policy. I mean, I really do think that we can do it. I think, though, that it takes the regulatory will, and I also think something that Josh pointed out, it also may take doing a much better job of standardizing the instruments so that we all know what we're talking about, and we can have an evaluation and a competition on a relatively small number of clear metrics.
Great. Yes, sir.
Thank you. Judge Schilling again. A quick comment and a quick question. The comment is, I like the comments on the regulatory reforms, which basically say that the regulations should require the market to act the way the free market theory it depends upon says it should act. And I think that that's very useful. My question is, if you look at the increase in real assets in the country in terms of investment over the past 8 years, it's been $20 to $25 trillion. If you look at the increase in financial assets, it's well over 100 trillion and maybe up to 200 trillion of all of these paper back and forth assets. My concern is, how do we make sure that the bailout packages of $1 trillion or something don't just go into monetizing these paper assets and make some way of, you know, having the counterparties write them off against each other or something like that, so that the financial support goes in to help the real economy to reform, resuscitate demand, to create the necessary jobs and stuff, and not just monetize the financial assets that were created that represent no real value.
I mean, I think there are at least 2 points. Unfortunately, to some extent, water is over the dam, at least with respect to the first 9 companies. And that being the case, everybody else will complain too. One is they should have been required to write down the assets before they got the money. That's what they did in Sweden. And that would have made, you know, that would have meant that hoarding the capital would have been a whole lot less tempting. The second is, come on, banks leverage at least 10 to 1, well, at least 7 to 1, frequently at 10 to 1. You could have made these banks leverage at 3 to 1 and accomplished something.
Which actually, well, and I hate to actually to take issue with something that's said by someone who's no longer here, but by the way, who left his watch. But, you know,
Towards the
you
debt,
also have
towards
to
the national
remember
debt.
that one of the values of having competing regulators is that we had one regulator. We had 50 state bank regulators, we had the OCC, OTS, FDIC, Fed, and SEC, arguably, in most of these cases. We only had one regulator who was in favor of a leverage ratio. And that regulator took a lot of heat for a lot of years on the leverage ratio. And can you imagine how bad things would be today if they actually had lost that battle? So, you know, this is part of, again, not to pick on someone who's not here, part of the reason that I think actually what one drops, the other might catch of the backup of the system. Unfortunately, in answer to your question, I wish that there was a way to ensure that, but at this point, I think that the goal has been stated by many, certainly in this administration, of netting those transactions and getting them behind us. And unfortunately, I think that we have, and this is where I was talking about first inning, second inning, third inning, I think we've actually defined the crisis as being the financial market problems as opposed to the real economy crisis. And I think we need to separate those into two different buckets and recognize that perhaps it's time to stop focusing on the former, because the larger, more significant, and more real one is the latter, which, by the way, is the reason, and I'm sorry, and I'll do this quickly. You know, we keep thinking in terms of small institutions getting fed to big institutions. And we know we've got 8,500 banks, many of whom need capital, even though they're suffering degenerative disease. It often wasn't of poor underwriting or arbitrage that caused them to have this problem. Maybe we should start thinking about when a large institution is troubled, we don't actually put it on life support, but now that we have the authorities, we think about breaking it up and feeding those deposits to the smaller institutions as their capital.
Urge everybody to show up at New America on the 19th of November when we're going to talk about the value of small banks and credit unions at great length.
I think
And
Josh just got added to the panel, I believe, yes. Bill, I don't know if you have to take off, but I wanted to get your take quickly on the way that the TARP plan went through the Congress and what you think the feeling was there. It was a difficult, between being a roadblock, a difficult balance between being a roadblock, but also getting in what they wanted, and then not having responsibility for some of the provisions that may or may not work out. How did you view that process?
Very messy, as they always are in these particular situations. A lot of pressure, a lot of movement. I was not specifically there. Other people in this room were there. My sense is that there was a strong sense something had to be done. It was and it was backed up against, we got to get out of town too, and go home and get reelected. And so I think that the confluence of those two just forced something through that probably wasn't thought through as well as it should have been, all the way along the lines of what has been already pointed out here, with a lot of issues that could have been dealt with. But there was a sense here that the crisis was at hand, and doing nothing would have worsened the situation. So what came out of it was the worst in terms of the legislative process, in terms of trying to just get it out of here as quickly as possible, and after it fails the first time, try it again and bring it back from the United States Senate. It was a convoluted process, and I think we're reaping some of the benefits of that convoluted process right now.
Okay.
And it will be revisited. I am positive of that.
Okay. We're going to have to close on that. Our panelists have been generous with their time. Please help me thank them, and thank you for attending.